Hello there, and welcome again to our beautiful sharing of the concepts of law here at YouTube. Today, I offer you the toughest subject in the afternoon in the bar examination, and every citizen is affected by the subject matter of taxation. In the bar examination, many do not pass the subject matter, which is in the second Sunday afternoon on taxation. And the bulk of the questions on taxation, probably about 40 to 45 questions all in all, about 60% of that comes from income tax. And of the 60% of income tax, about between 36 to 40% come from gross income. And so that therefore, this initial sharing with you will be touching on gross income of the subject matter of income tax. Just to get some sentimental notes here, I dedicate this in trying to remember my first professor in taxation at the University of the East College of Business Administration when I was taking up accounting in the mid 60s. I will never forget him. He was very impressive. He became congressman of the district in Leyte. His name is Congressman Cirilo Roy G. Montejo. And the second professor that impressed me, also teaching at the University of the East when I was an undergraduate, again mid early 60s, was attorney Macario Perez. Sentimentally, I have not met these two revered professors of mine after I graduated from college, but they impressed me as two of the most outstanding professors that influenced me to love taxation. In fact, my first and only book so far is in the subject matter of income taxation when I came up with my notes to become a published book by Central Book Supply, a bar reviewer in taxation, which was very popular. So without much ado, let us start our ball rolling here. Just in case you missed it, there is a little note, little icon downstairs here on the lower right hand corner, which is subscribe. Just click it. This is not the one that you click. It is that particular small item at the bottom right of this screen. To start the ball rolling on taxation, our coverage on the income tax scenario will include gross income, which is the substantive portion of this today's sharing. And it will be followed by deductions, which will only affect corporations and persons engaged in business. And then whatever remains of the exemptions under the train law. And so to start the ball rolling on gross income, we will cover the concept of income. And then we will proceed with items of inclusions in the gross income. And finally, we will have our exclusions from gross income. The Montevideo Convention in Uruguay, sometime in the 1926, convened the leading nations of the world because of the advent that so many colonies at that time were getting their independence, and there was a question on how do the leading nations of the world recognize these evolving nations. And so it came to pass that the Montevideo Convention identified the elements of a state as people, territory, government, and sovereignty, and the existence of these four units, a very beautiful concept in political science and political law, brings about the existence of a state. When a state gets to be formed, then it automatically gets what is called the inherent powers of a state, represented by that beautiful word pet. Para bang yung state meron siyang tuta na ang tawag ay pet niya. And pet would stand for one, P is for police power. Second is after police power, the state has a second power, E, which is eminent domain. And the third inherent power, which is the subject matter of our discussion on this presentation, is taxation. We will have a separate YouTube upload on concepts of taxation. But here, let me just advance the hypothesis that when the state, therefore, needs to raise money for its existence, for its functioning, and to be able to fulfill its mission to its people, then it has to collect contributions, enforced proportionate contributions from his people. And the basis, therefore, of collecting from this forced contribution is to tax the privileges that are given to the people which comprise the sovereign state. For instance, the people within the state would have the privilege to use property, specifically land and buildings and even machinery. And in the process, the state says, well, I'm giving you the privilege to use that, but I will use the value of the property that you're using to impose a tax on you. And that is how the real property tax came about. The state also says that I'm not a communist state, if it is not, and therefore I would allow you to pick your choice on whatever commodities you'd like to buy. But in your exercise of buying, then I will use the value of what you're buying as a basis of taxation. This brought about what is called the value added tax. Also, the state says that I am giving you the privilege to pass on, to donate, to give to your family, especially your wife and your children, and to any other person that you would fancy to, subject to certain regulations under civil law. But when you exercise the privilege to donate, to give away your property while you are still alive in a donation inter vivos, then the value of the property you are giving away becomes a basis of taxation under donor's tax. And if you should wait to pass away, it is your estate that gives away that property. Your estate also is charged with the tax on the privilege to pass on your property using estate tax. The subject matter of this discussion is you have the privilege to earn income. Because in other types of political structures, the privilege to earn income does not belong to an individual or to a corporation. Any efforts of an individual is supposed to be in behalf of the state. And so that person may not be substantially compensated and doesn't earn income, meaning he doesn't have the opportunity to build up wealth. But under certain governmental setup, which includes the Republic of the Philippines, everybody has the privilege to earn income, and the government says, I will use the income you earn as a basis of imposing a tax, your contribution to the state. And that is how income tax came into being. Which leads us, therefore, to understand what is the concept of income. And so we now say that income is any money coming to a person as payment to him for the services he performed, or the interest that is being paid on the money that was borrowed from him, or the profit from his buy then sell activity. Also, income would represent any wealth which flows into the taxpayer other than as a return of capital. And finally, income would represent all kinds of incomes derived from whatever source. We are now ready to include to take up now what are included in gross income for income tax purposes. Exclusions to gross income. We have two general types of gross income. We have what are called active incomes, and we have what are called passive incomes. And we will try to understand that those two in detail. Insofar as active income is concerned, we say that active income represents income earned through the actual, direct, personal effort of the taxpayer, made physically, mentally, or both, whether or not with the assistance of financial or equivalent resources. So in active income, it is the individual who ultimately pays the tax, who is actually performing service. He is directly performing service, and he is personally exerting effort to render that service. Insofar as the supposed uh, passive income is concerned, while the active income involves the person directly, actually, and personally exerting effort. In passive income, the income that is earned by the taxpayer is coming from his cash, coming from his properties, and or other financially viable resources without the actual direct personal effort of the taxpayer. Here, the concept of passive income is that he has properties, to include cash properties and other financially viable resources, that are used to generate income for him. And because he is the owner of those properties, then the income of those properties under the civil code provision, the fruits of those properties belong to the owner of those properties, and those are what comprise passive incomes. In the area again of active income, there are three situations where an individual can earn income. The first situation is a person decides to be working for another person under the concept of employer-employee relationship, the area where the labor code comes in. The second one is a person could have developed certain skills or talents that allows him to exercise these skills to serve targeted clientele. And it is a profession, if the government would license that professional to practice that profession after passing a minimum qualifying examination given by government. In the case of trade, Well, essentially, those who are individuals who are involved in buy and sell, or it is possible that that particular person has talents. No? For example, the talent of in music, the talent of blue collar types of jobs like carpenters, masons, electricians, all of these would be in the area of trade. It is their special skills, even without passing a government qualifying exam, that allows them to earn income. And finally, the third scenario where a person can be earning active income is if he is engaged in business. And the simple concept of business is that I buy cheap goods and I sell at a higher price, and the difference between my selling price and my buying price becomes my profit. That's a concept. I buy cheap, I sell more, I make profits. I buy cheap, I sell more, and I make profits. So this is the structure of an active income earned through business. Let us now take a look at how an employee earns active income which becomes subject to income tax under an employer-employee relationship. When an employee dedicates his time and effort to work with an employer, then we now say that that particular person deserves to be given compensation, which can either be salaries or they can be wages. They're essentially the same, except in business parlance, when we say salaries, they would represent the base compensation for services rendered by regular and probationary monthly paid employees, whether managerial, supervisory, or rank and file, usually paid every 15th and 30th. When we use wages, we mean the base compensation for services rendered by daily or hourly rated employees, mostly regular or contractual rank and file workers, paid usually on a weekly basis. The salaries and wages are base compensation, but employees also get other additional compensation, which in totality has been called fringe benefits. And so the fringe benefits would represent any goods, any commodities, service, or other benefit furnished by an employer to an employee, granted in cash or in kind in addition to the basic salaries. And all benefits received as a general rule under an employer-employee relationship are part of taxable gross compensation income. So if there is any doubt, the universe of monies and goods, no, that an employee receives from his employer arising from their employer-employee relationship are all taxable compensation. No ifs or buts about that. Having said that, there are certain fringe benefits where there is no tax burden to the employee. The first one is what are called the minimis benefits. The second one is benefits received under the employer convenience rule. And the third one are benefits called fringe benefits tax. And so now there are three groups of fringe benefits that even when given and received by the employee from the employer, they are not subject to income taxation. So the first is, let us take a look at the minimis benefits. Before we go into the specifics of the minimis benefits, let's just take a broader view of what are the types of fringe benefits that an employer can give his employees. Number one, would be leaves with pay. In other words, a person, following the principle of no work, no pay, can be given some exceptions where even if he's not working, he gets paid. And so we call them in the generic categorization as leaves with pay. And that would include vacation leaves, sick leaves, emergency leaves, and maternity and paternity leaves. Several of these are provided for under our labor code in the area of labor standards. The employee can also get medical benefits to include medical and physical examination for free, medical insurance, free medicines and hospitalization, and PhilHealth benefits. The employee can also get additional financial compensation and assistance by way of subsistence allowance, rice subsidy, night differential pay, free meals and snacks, overtime pay with premium, and hazard pay. And some employees can enjoy accommodations and convenience like housing or free board and lodging, company car plans and free transportation, travel, representation and entertainment, premiums on life insurance, household personnel such as maids, cooks, drivers, and gardeners paid for by the employer, and membership dues in associations. Other financial benefits that an employee may receive would be company loans and cash advances, interest subsidies, especially when you work with a bank. It is possible that the bank has a fringe benefit where its employees can borrow money somewhere as a percentage of their income and would be paying interest expense at a level lower than market. And other financial benefits would include the fringe benefits tax that we will cover extensively. Other benefits would include, for instance, free uniform and laundry, employee achievement awards, and Christmas and major anniversary celebration gifts. For financial bonus, we know that the law requires 13th month pay, but your employer may be willing to give another month called 14th month pay. And so therefore, having seen the universe of benefits that may be given to an employee, the question is, are all of these benefits taxable? The general rule is yes, all types of benefits are subject to tax. However, the government has seen it appropriate to define certain small benefits of small value that are not subjected to taxation, and they have been grouped by the acronym de minimis benefits. So de minimis benefits represent facilities or privileges or courtesy discounts on purchases of relatively small value. Take note of that very important term, the de minimis, meaning maliit, no, is really referring to the benefit that is relatively small value which the employer gives to his employee for their health and contentment, to encourage their efficiency while fostering goodwill. We will now list these fringe benefits that are included in the previous list that was shown, and we will determine what is the maximum component of that benefit that is tax-free. In the case of leaves with pay, when an employee enjoys a vacation leave, normally is given by in industry practice 15 days, and some depending on their length of service can include that can increase that from 15 to 16 to 17 to 20 or even more. depending upon company policy. That is a fringe benefit, but that is not the interesting component of the minimis benefits. The tax law provides that if an employee has a vacation leave but he did not use it, you know, and the employee therefore, as a general rule, if the employee does not use it, then the benefit goes away on a year-to-year basis. But many companies arising from both the collective bargaining agreement consensus as well as the benevolent act of the employer provided that if the employee did not avail of his vacation leave for any reason whatsoever, including heavy workload, then that particular employee may be given the option to convert that vacation leave pay into money. So he says, I did not take my 15-day vacation leave. Sir, can you pay me 15 days of my pay? And the employer, by way of a company policy or by way of a CBA provision, may give that particular employee 15 days pay equivalent. However, as a general rule, the 15 days is part of gross income that is taxable. But government said, okay, I will understand that you should have rested and you did not, and you got a conversion. I will tax that particular conversion, but I will allow you 10 days that is not taxable. So if you were given 15 days and you got cash equivalent of 15 days, I will allow you not to be taxed on the first 10 days. In excess of 10 days, in your case 15 days, the extra 5 days becomes now taxable income. So what is the minimis is the 10 days. What is taxable is the 5 days converted, vacation leave converted to cash. In the case of government officials and employees, and they enjoy their vacation leaves, and many of them would wait for the retirement days, so they have what is called terminal leave, and therefore terminal pay, the accumulation of all their vacations. Insofar as the tax law is concerned, all employees, and government and officials and employees who get their vacation leave in cash are totally not subject to tax, 100%. Now, while we will go into the medical benefits, let me just mention that we did not touch here, but we will later on the other type of leave, sick leave. In many companies, the vacation leave is 15 days and the sick leave is also 15 days, where the employee, if he's not feeling well, he's sick, can take a leave and he will still be paid, and that's 15 days. Now the question is, what if he did not get sick, he did not avail of the 15-day sick leave, and the company has a policy after 1 year, then that 15-day unused sick leave is converted also into cash. The law does not include the conversion to cash of sick leaves unused as de minimis benefits. Ergo, if an employee has 15-day sick leave and he did not use any of the 15 days, then if he were to be paid cash, the payment of cash is all part of taxable income. Nothing is included in the minimis benefits. The medical benefits that a worker, an employee can get would include medical cash allowance of employees' dependents, and the law provides 750 pesos per semester or 120 pesos per month as the minimis benefits. Meaning, if the employee is given 125 pesos per month total, that particular 125 given to him in cash will not be subject to tax under the de minimis benefits provision. Anything in excess of 125, say 150, the difference of 25 pesos per month will now be included as taxable income for the employee and not included in the minimis benefits. The other one that may be included as tax-free de minimis benefits would be medical assistance. These are medical and healthcare needs, medical executive checkups, maternity assistance, and routine consultations, provided the medical assistance given to the employee does not exceed 10,000 pesos per year. If it is 10,000 or less, then it is not subject to tax. But if he is paid 15,000, the first 10,000 is the minimis benefits, the extra 5,000 is included as taxable gross income. Additional financial compensation and assistance, for example, you have your rice subsidy. That's now 2,000 per month, equivalent to 50 kilos of rice. And this has been adjusted time and again. If I recall right, this started with 1,200 couple of years back. Then it was increased to 1,500 and then to the present 2,000 pesos per year. This 2,000 is the latest in the train law provision. The employee may also be getting a daily meal allowance for working overtime and for being in the night or graveyard shift. And he can be given at 25 0.20, actually it's 0.0025% no, of basic minimum wage. And then other benefits would include that are de minimis would include uniform and clothing allowance where you have 6,000 per year uniform that is de minimis benefits. And there are so many industries affected by this. In the semiconductor industry, for purposes of the requirement of cleanliness and to bar any contamination of the integrated circuits being assembled, the employees are provided smocks, and so they're used to even wearing before this pandemic the face masks that we now see as has become a regular daily requirement for everybody. Those who have been working with the semiconductor industry have been used to wearing, the smock uniform, just like the way you see it in movies being worn by astronauts or something like that, and then of course the face mask. Now, also very popular are those uniformed personnel in the Armed Forces of the Philippines and the Philippine National Police. Obviously, they will be given their own uniforms to standardize their appearance in the performance of their duty, and they will enjoy a 6,000 per year allowance for those uniforms. Because employees are required to wear uniforms provided for, then they also need to wash that, and so there is a laundry allowance per month of 300 pesos that is de minimis benefits, not taxable. And employees are given achievement awards on the basis of length of service or probably their observance of safety requirements. And these are to be given not in cash, but intangible personal property. The most popular, of course, are the wristwatches that are being given to employees or, or rings, for souvenir purposes. I got this little souvenir from De La Salle University when I achieved my 20 years of continuous service as an MBA professor. And when this is not in excess of 10,000, they are de minimis benefits. And I do not know how much that was valued, but when I checked with Rustans, it appears that the market value 17,000. Strictly speaking, 10,000 is the minimis, the 7,000 extra is taxable to me. I do not recall whether I did declare the 7,000 as part of my gross income. And I hope this confession does not merit the BIR in issuing his deficiency assessment of 7,000 against me. I am very sure that award was given way, way before the prescriptive period of 5 years done in good faith. Also, an employee may be receiving gifts per year during Christmas and major anniversary celebrations, and they will not be subject to tax. They will be de minimis benefits provided they do not exceed 5,000 pesos. And additional benefits like received from the collective bargaining agreement or productivity incentive scheme, almost similar to what I was mentioning here in the safety achievement. And so in the signing, as part of the signing bonus, the employees were given, the members of the union were given 10,000 each. The 10,000 is considered the minimis benefits, not subject to tax. But anything in excess of 10,000 will be part of taxable gross income. And finally, 13th month pay. The 13th month pay is normally not taxable, but the government, under the train law, has set up a certain ceiling following previous year's practices, but is increased it to 90,000. So that any person who gets to receive his 13th month pay of 90,000 or below will not be subject to tax. But if the salary is only, say, 60,000, the balance of 90 minus 60 or 30 can be included as part of the other benefits not subject to tax under the minimis benefits rule. To summarize, the tax-free de minimis benefits of a rank-and-file employee, let us take a look at a listing here. Let us say this particular employee must have worked for quite some time and is receiving right now 50,000 pesos per month. On 12 months, he is getting 600,000 pesos. And when we listed down the de minimis benefits he's receiving or the benefits he's receiving, vacation leave, he is paid 15,000 and he will only be entitled to the minimis of 10,000, so he will have a taxable income of 5,000. I simply did not consider the 50,000 leave. It's just a hypothetical number. If the employee has his sick leave converted to cash, there is no de minimis benefit to him. The 15,000 will all be subjected to taxation. Medical allowance of 1,450, de minimis. Rice subsidy of 2,000, that's times 12 months, is 24, de minimis. Uniform and clothing allowance, 6,000, de minimis. Medical assistance to its dependents, 10,000, de minimis benefits. Laundry allowance of 300 per month times 12, 3,600, again, de minimis. Employees' achievement not exceeding 10,000 provided not paid in cash but intangible personal property like watches and rings, 10,000. Gifts received on Christmas and other special occasions not exceed 5,000 is de minimis. Meal allowance of 0.25%, that's 68,000 for one whole year, again de minimis. And CBA benefits given to him 6,000. That was also given in the and so out of the total compensation, the de minimis benefits amounted to 164,000 and only 20,000 is taxable and therefore included in the taxable compensation of the employee. His 13th month's pay is 50,000 and again not included in taxable income. So while his gross income is 814, the government will only impose a tax of 620,000 against him, with a personal exemption of 50,000. His net taxable income or his gross income is 814,500, but he will only be carrying the burden of 570,000 as the taxable income. So that shows the de minimis benefits. Let us move now to another very interesting set of fringe benefits where the government does not impose any income tax, and that is under the employer convenience rule. In the employer convenience rule, the philosophy is that the employee's fringe benefit is not taxable when his employer gives the benefit for the employer's primary convenience and incidentally necessary for the employee to perform his duties properly. Here, while it is true that the employee is receiving a certain fringe benefit, the truth of the matter is that the primary beneficiary is the employer because he needs that particular employee, no, in order for the employer to live up to certain commitments, as we will see. And therefore, it also helps the employee serve his particular employer. As an example, we have here an employee who is a stay-in driver of an employer who is a doctor in the field of obstetrics and gynecology. The driver is given live-in quarters and meals beyond the 8-hour working hours at 5 o'clock in the afternoon. And so he has a living quarters and is given free meals, normally taxable. But under the employer convenience rule, if the reason why he's given free quarters and meals is because the obstetrician gynecologist has to wake up and rush to the hospital to answer the need of an infanticipating client, a patient, then the stay-in driver becomes a necessity for the primary convenience of the doctor. So therefore, all of this would now be active income but excluded from taxation. Second one that is very, very visible are the officers and enlisted men of the Armed Forces of the Philippines and by parallelism also the Philippine National Police. That because when they are on duty and they are not therefore in their residences, they would be provided barracks and living quarters. That is assuming they are not in the field in an active mission. Because on the other hand, if they are right there on the front line, they have no barracks or living quarters. They are actually embedded in the soil, with all the dirt. And that is part of their duty. But when they are not in the actual field of combat, then they're given living quarters that will make them accessible for any call of duty. They're also given subsistence for the allowance, and this is very important in order for our soldiers not to be under pressure to feed themselves by getting on the chickens and the other goods from the inhabitants or residents of the communities they're servicing. Obviously, we do not expect our soldiers and police officers to be in different types of outfit. They would look like a bunch of people who do not have that kind of aura of discipline. And so when these are given to our armed forces and PNP officers and enlisted men, they will fall under the rule on the employer convenience rule. And their employer is the Republic of the Philippines. Another type of employee that was given in the bar examination is a fish pond caretaker, where you have the employer who is a fish pond owner operator. He has probably a couple of fish and so on in a fish farm, and the caretaker may have a living quarter there, and meals. Again, it is not for his ultimate benefit, but for the benefit of the fish pond owner operator's business. And so these particular types of situations are examples of the employer convenience rule. And so we now move to the third fringe benefit grouping with no tax burden to the employee. Here we talk about the fringe benefits tax. The fringe benefits tax is actually income tax, which the employer pays in behalf of his managerial or supervisory employee for a fringe benefit furnished, granted or paid to cover the employee's private use of the benefit. In effect, you can imagine, you can envision here that because of the principle that all benefits are taxable, a managerial employee gets a certain fringe benefit, and we will see very good examples. And therefore, it is the employee who should pay for the tax on his extra compensation by way of a fringe benefit. But when the employer says that, okay, I will help you out, I will be the one to pay for the tax of your fringe benefit, then the tax that is being paid by the employer that should be paid by the employee is what is an income tax that is called the fringe benefits tax. The fringe benefits tax is the difference between the gross up fringe benefit, meaning the benefit divided by 100% less 32% or 68%, and the annual benefit granted. We will demonstrate this in a little while. But you imagine a situation where an employee gets a fringe benefit, and the presumption is that there is a tax that has already been imputed into that. And so you try to gross up the whole amount, and you are able to derive therefore the gross up amount minus the net benefit. The differential would be deemed to be the tax that should have been paid by him to be paid by the employer. So the employer may be an individual, a professional partnership, take note, professional partnership, a corporation, whether taxable or not, or the government and its instrumentalities. I'd like to highlight here that even if the taxpayer is not taxable, he will still have to pay the fringe benefits tax, because while he is doing the paying, he is really paying in behalf of the employee for whom he is making the payment. So it is irrelevant that the employer is not taxable because he is not the one being taxed. It is his employee who's receiving the benefit, but he agreed to pay in behalf of the employee. And even the government on its political and non-political instrumentalities are liable to pay the fringe benefits tax. Benefits subject to fringe benefits tax, very popular, is the car plan of many companies, especially for its supervisors and managers, foreign travel expenses, holiday and vacation expenses, housing, household personnel like maids, cooks, drivers, and gardeners provided for, especially for expats of multinational companies living in such plus villages as Ayala Alabang, expense accounts, membership fees, dues, and expenses in social and athletic clubs or other similar organizations, life or health insurance or other non-life insurance premiums in excess of what the law allows, educational assistance to the employee or his dependents, and interest on loans. One example we can give is the very popular car plan for executives. Here, the principle is the fringe benefits tax is due whether the vehicle is used partly to benefit the employer and for the employer's personal benefit. Actually, that should have been employee's personal benefit. So, to simplify, when a company buys a car for the employee and the employee uses that to commute from his house to the office and back. But in between, he also attends meetings for the company. The fringe benefits tax concept no longer makes a distinction on whether the car was used for personal versus official functions. That particular car given to him is considered subject to fringe benefits tax. However, there are certain cars and vehicles that are not considered under the car plan, and these are the vehicles for the sales group, for delivery, for freight, delivery service, and other non-personal use. They are not considered as fringe benefits for purposes of imposing the fringe benefits tax, but are business expenses. Cars considered fringe benefits are under the employee's name. So when you talk about a car plan, and the plan is and the car is under the name of the employee, automatically that is subject to tax in his name. And if he is not willing to pay, but his employer is willing to pay, then that setup falls under the fringe benefits tax concept. Here is how the fringe benefits are grossed up. And there are three examples here. First, a regular managerial employee, a non-resident alien employee not in trade or business, and special alien employees of the regional headquarters. For regular managerial employees, the rate to gross up is at 32%, which is the corporate rate. For the non-resident alien employee, the rate is 25%, and special alien employee regional headquarters is 15%. Here is an example of a car plan. This is a Fortuner based on present market value whose acquisition cost may be 2 million, and the company, the employer has the option to pay the 2 million and give the car to the employee registered in his name. Or the employer can give 2 million to the employee who in turn buys the car. Or the third option is that the company can engage a car financing company, and would be willing to pay interest on the borrowings of 2 million. Or a company can enter into a lease agreement, actually a financial lease agreement, where a company buys the car and leases it to the company for the use of the employee. And therefore, the company is scheduled to pay 57,500 for the use of the car for, say, the next non-cancelable lease for the next 5 years. So here is how the transaction can occur. One, the employer buys for cash, or the employer gives the cash to the employee. In either case, 2 million is paid by the company to buy the car. The fringe benefit is 2 million divided by 100% minus 32%, and the amount that will be the gross up amount is 2,941,176. The cost of the car acquisition is 2 million, and so therefore the difference, which is the gross up differential, is 941,176 in red, and this therefore would represent the fringe benefits tax, the tax that otherwise the employer should be paying the government had he been the one responsible for receiving the 2 million and paying the government the corresponding tax of 941 arising from the grant of the fringe benefit of 2 million in his favor. On the other hand, if the employer were to buy on installment, no, and the installment monthly payment is 57,500 times 5 years times 12 months, that would be equivalent to 3,452,156. And since the car's purchase price was 2 million, the difference of 1,452,156 becomes now the interest to be included. And so that 1,452,156 would not be considered as part of fringe benefits tax. The computation would still be at 2 million divided by 5 years, because the term is 5 years, divided by 100% minus 32%. Obviously, the amount should still be identical had the corporation bought the car for cash. And so that essentially covers the active income under an employer-employee relationship, where you have the taxable fringe benefits here being discussed, and three areas where the fringe benefits would not be subjected to tax under the minimis benefits, relatively small value, employer convenience rule, and the fringe benefits tax. The second area, which is included in gross income, is when a particular person engages in the profession or trade. And this is active income for professionals to include lawyers for their attorney's fees, medical doctor for their consultation fee, CPA for their audit fees, engineers for their professional fees, as well as architects, and the consultants for their consultant fees, and agents for agents' commission. Take note that almost all of these require a government qualifying examination under the Professional Regulations Commission. However, there are certain individuals who may be rendering their own trade or service arising from their talent, such as singer who enjoys a talent fee. So you can have here, for example, Martin Rivera singing in a concert and being paid his talent fee. Musician, that would include all of those members of the orchestra that accompanies him. Actor and actress, they appear, and very popular, of course, on TV is si Coco Martin as Cardo in the El Provinciano. Dance instructor and instructress, service fee. Electrician also service fee. Welder service fee, and masseur service fee. So these are some of the examples of those who are engaged in the practice of their profession or trade, earning active income. We will hold the discussion of those taxpayers in business in the second upload, where we will discuss the deductions to link up why are businesses allowed deductions while individuals under employer-employee relationship do not enjoy any of these, what we call these deductions. Now, let us reiterate that passive income would represent incomes where the taxpayer's properties are the ones earning for him and still also taxable. Let's take a look. Some significant highlights of passive income would be: one, we already just said that their income earned with the taxpayer's cash, properties, and other financially viable resources without the actual or direct personal effort of the taxpayer. Now, very interesting highlight is that while the regular active incomes are taxable by way of including them in the income tax return of the taxpayer, the passive incomes are subjected to final withholding tax at source. So the passive incomes are subject to withholding tax at source, and they are excluded from the income tax return because the final withholding tax has already been withheld and paid by the buyer. Some of the examples of passive incomes in the area of cash investment. So it's the taxpayer using its cash in order to generate certain passive income. There are four that are listed here. An individual may have made bank deposits from savings account to time deposits and all the variations in investment with banks, and they expect to generate interest income. The same is true when that particular taxpayer lends out by way of mutuum or investment in bonds. Again, also interest income. Or the taxpayer may decide to buy shares of stocks to become co-owners of corporations, expecting that if the corporation makes money or profits, then it will declare cash dividends in his favor. And finally, he may go to the casino and put his gambling bets and he wins. Of course, he can also lose and makes winnings and prizes. The taxpayer may, in addition to cash, have his real and or personal properties such as land, buildings, equipment, and vehicles. And when he engages in leasing these particular properties of land, buildings, equipment, and vehicles, he derives rent income which is subject to tax. Again, he's not the one physically, directly, and actually involved in the earning of the rent income. It is his building, it is his land, it is his equipment, it is his land, what they call these vehicles. We will talk about capital gains tax in a little while when instead of leasing out the property, he sells the property. Next, he must have some intellectual properties, intangible assets like inventions or that would deserve the earning of royalties. So let us now go to when the taxpayer now starts selling his land, buildings, equipment, and vehicles that brings about the capital gains and losses situation. Before we can understand the concept of capital gains and losses, there is a need for us to make a distinction between two types of assets that a taxpayer may be owning. The first type of asset that a taxpayer may be owning is called ordinary asset. The ordinary asset that includes, for example, the inventories in supermarkets and the goodies in the department stores. They are considered ordinary assets because they are for sale in the ordinary course of business. They will include, as I already mentioned, stocks in trade or inventories, and we can see that in SM, we can see that is in SNR, we can see that, for example, in Mercury Drug, they have inventories of their products. Or instead of movables, that particular establishment may have immovables like land and building, but they are engaged in the business of real estate and they're selling these particular buildings. So those are real or immovable properties also for sale in business. These two types are considered ordinary assets. They're for sale. It's a normal course of events. A taxpayer may also have ordinary assets in the form of those that he owns because he uses it in the business. And the first category is his depreciable property used in business. He has his buildings, his machinery, his furniture and fixture. And he does not normally intend to sell them because he's using them in business. The same can be said of those properties where I would just like to fix this particular picture where he has real properties like the land where the buildings and machinery and equipment are situated, but the real properties are not intended for sale. They're intended to be the site of his business in that particular endeavor. So both of these, those that are for sale and those that are for use, are considered ordinary assets. On the other hand, When there are assets that are not for sale or for use, then they are considered capital assets. That's why capital assets are assets not for sale nor used in business. Then they will include these two major categories: investment in shares of stocks and bonds. So when a particular taxpayer buys San Miguel shares, buys Petron shares, buys any other shares or bonds, then that particular investment in shares of stocks and bonds are considered capital assets. In the case of individuals, when you have your residential house or you have certain lands that you bought that are idle and they're not being used for business, then they're called capital assets. And that would also include those that were purchased for purposes of anticipating increases in the land values. How do we make capital gains? In the case of investment in shares of stocks, and you did not buy this through the stock market, like in my case, I have some shares of stocks with the University of Manila, and shares, being a closed corporation, are not traded in the stock exchange. If I were to decide to sell my investment with University of Manila, my taxability in terms of capital gains is 5% of the gains of 100,000 and 10% of the gains over 100,000. In the case of residential or idle lands, the tax would be, and this is the capital gains tax of 6% of the gross selling price or fair market value at the time of sale, whichever is higher. Now, continuing with the capital gains on sale of residence tax exempt, the presumed capital gains from sale or disposition of principal residence are exempt from the 6% capital gains tax. Tingnan nyo ha. So, under normal conditions, when you sell your residence, you're subject to the 6% capital gains. However, there is no tax, zero capital gains tax, when that particular residence falls under these 5 categories. 1, the sales proceeds are fully utilized to acquire or construct a new residence. Second, the acquisition or construction is done within 18 months from the date of sale. Third, the historical cost of real property sold shall be carried over as the cost of the new residence for subsequent capital gains tax purposes, regardless of the actual cost of purchase or construction. Number 4, when the sales proceeds were not fully utilized, the excess shall be subject to the 6% capital gains tax. And this exemption may only be availed of once every 10 years. And so we have seen, ladies and gentlemen, the two types of incomes, the active income and the passive income, that would be included in the gross income of the taxpayer who is either an employee or a professional or, engaged in his own profession. And so that therefore, we have already considered the two major categories of incomes that the taxpayer may be subjected to. Now, the final reckoning point are there certain incomes other than the three, the minimis benefits, the employer convenience rule, and fringe benefits tax, that are excluded from gross income? And this is our final grouping in this particular presentation. What are excluded from gross income? Gross incomes are excluded when they are, insofar as they're related to or incident to sovereignty. And this will now include, under international relationships, 3, income from investment by a foreign government. So if a Singapore government makes a direct investment with, for example, buying shares with San Miguel, then any dividends income from such investment by Singapore will be excluded from gross income of Singapore. This is obvious because one sovereign government, the Republic of the Philippines, cannot be superior to the sovereign government of Singapore. Otherwise, there will be a lot of confusion and the opportunity for execution becomes difficult. Income exempt under treaty. There can be certain symbiotic treaty between two countries like the United States and the Philippines. There can be a treaty of exemption from the two. The international organizations under treaty, more so through the United Nations facilities, are also not subject to income tax, such as the United Nations Agency in the Philippines. Now, insofar as sovereignty is concerned, there may be certain exclusions from gross income arising from internal sovereignty, and this is very valid in the case of income by the government or its political subdivisions. Take note, political subdivisions, because when government engages in business, it sheds off its sovereign exemption and is subjected to the usual rules on business and taxation. Income from essential government functions. So when the government through the Land Transportation Office registers vehicles, then it is not subject to tax. And incomes from public utilities are excluded from gross income. Government fiscal incentives, for example, prizes and awards in sports competitions, prizes and awards for achievement in religious, charitable, scientific, educational, artistic, literary, and civic activities, gains from sale of bonds, debentures, or certificates of indebtedness maturing in more than 5 years. That is the reason why the banks would offer you certain investments where you will notice beyond 5 years suddenly the interest incomes, the yields are higher. It is because if the investment in bonds, debentures, certificates are made within beyond the 5 year holding period, then they are not subjected to, they're excluded from gross income. Continuing with the government financial fiscal incentives, gains from the redemption of investment in stocks of mutual funds. Compensatory reimbursements would also be excluded, such as proceeds of life insurance to heirs and beneficiaries, return of premiums to the insured, and compensation for injuries or sickness. They do not comprise income in the true sense of the word. Continuing further, under an employer-employee relationship, there are 5 categories which are not excluded, which are excluded, in addition to what we mentioned about the minimis benefits, about the employer convenience rule, and about the fringe benefits tax. These 3, falling under the employer-employee relationship, would not be subjected to tax. They're excluded from gross income, to include retirement benefits, pensions and gratuities, the 13th month pay and other benefits, and the GSIS, SSS, PhilHealth, and labor union dues. Take note of labor union dues. This was not yet given so far in the bar examination. To further understand why is proceeds of life insurance to heirs and beneficiaries excluded from gross income, let's take a look. Proceeds of life insurance paid to irrevocable heirs or beneficiaries are excluded from gross income and exempt from taxation. The proceeds of life insurance policy payable to a revocable beneficiary forms part of the decedent's gross estate whether or not the insured exercise the revocation. Take note, if the insurance proceeds were covered by irrevocable designation of beneficiaries, there is no gross income at all or no tax incidence. First of all, the proceeds of life insurance is essentially more of a compensation for the loss of the earning power of the loved one. And so that would not be subjected to tax. However, if the life insurance policy, no, has proceeds but payable to a revocable beneficiary, under insurance law, the designation of the beneficiary is by way of a default provision irrevocable. But if the insured party initiated and succeeded in asking the insurance company to designate the beneficiary as revocable, and the insured party therefore dies, the proceeds of life insurance to that revocable beneficiary will be computed as part of the decedent's gross estate. Whether or not the deceased person exercised that revocability. However, assuming that that particular proceeds of a revocable life insurance is included and taxed as part of the decedent's gross estate, the net proceeds did not mean that it invalidates the designation of the revocable beneficiary. Ergo, the revocable beneficiary will continue to receive the proceeds of life insurance, minus, of course, the impact of the decedent's what they call this estate tax on that particular thing, which is 6% now under the train law. What about the premium of life insurance? Premiums for life insurance on a key officer with his family as beneficiary are deductible business expense when said family members are not so related with the corporation as to make the corporation the indirect beneficiary. So here is a situation where you have, for example, the president and general manager, and he insured himself and the premium is being paid by the organization. As it will become a deductible expense. It will not be considered under the fringe benefits tax rule. It will be deductible as an expense because the corporation, would lose his services somehow, But if the beneficiary are his family and they are not in any manner related to the corporation, then the premium is qualified as a business expense. However, when the premium payments are additional compensation to the officer to be part of his taxable gross income, unless the employer pays the related fringe benefits tax. Okay, I think that is quite clear. Let us now go to compensation for injuries or sickness. The rule on exclusion of compensation for injuries or sickness revolves around the amounts received through accident or health insurance or under Workmen's Compensation Act as compensation for personal injuries or sickness, plus the amount of any damage received, whether by suit or agreement on account of such injuries or sickness, shall not be included in gross income. The philosophy here is you are not making any income, but you are simply you're being refunded for the injury that you suffered. And so there is no component of income in awards for injuries or sickness by way of damage suits. The retirement benefits, pensions, and gratuities are generally excluded from gross income. But let us take a look at that. Involuntary separation benefits. The causes for separation beyond the employee's control are 1. Death, 2. Sickness, 3. Permanent disability, and then 4. Retrenchment, redundancy, and closure of the business or company. Very sentimentally linked up to the labor code. Any amount received by an official or employee or by his heirs from the employer as a consequence of separation from the service beyond the control of said official or employee is excluded from gross income. In other words, you no longer punish a person who has lost his job because of the following reasons. You let him go, just pay him whatever he deserves as separation pay. When the separation of employee is beyond his control, any and all amounts that he receives as a result thereof is exempt from income taxation. Continuing with involuntary separation benefits, if there is any terminal leave pay, vacation leaves, such as mentioned here, the accumulated vacation and sick leave credits of an employee who separated involuntarily, and the terminal leave pay, which is part of the tax-exempt separation pay, is likewise exempt. And we are about to go into the what they call this 13th month pay. Actually, it's in here. And so that would be our last subject matter, the 13th month pay. And we're saying here that in the case of the 13th month pay, uh, bonuses and other benefits in excess, I stand corrected here. This should now be based on the train law, not 30,000 but 90,000. The normal tax coverage applies because separation did not bring about receipt of the 13th month pay. So here, it will follow the same rule. If the employee was separated and part of the separation pay is his unpaid 13th month pay, he will still be entitled to tax-free 13th month pay, provided it does not exceed the 90,000 that was mentioned in our latest train law. And so, ladies and gentlemen, we have effectively covered our subject matter on this upload on gross income. And so we need to revisit our following topics. The next slides would cover, after this slide, the types of Philippine taxpayers. We will cover taxpayers, active income, engaged in business. That would lead us to the discussion on what we call this on deductions of the business and whatever topics that would remain in income taxation. Again, let me see. This is what we intend to cover in the next upload after this one. So this is already the complete one on gross income. But the following subject matter on deductions, including of course the different types of Philippine taxpayers and all the ramifications, will be included in the next upload of slides. I would like again to thank you for being with me, for sharing this dedication of this lecture to my former professors in taxation. After I was their student in the 60s, and I enjoyed being with them, and I hope they also enjoyed being my professors. I sentimentally remember them, and whenever I speak about taxation, their images, their friendship, their authority to discuss and introduce to me taxation always comes back. And so if you have a little few minutes, a few seconds to say a beautiful prayer for them. I know Congressman Cirilo Roy G. Montejo has already passed away. I am not sure about Attorney Macario Perez. I only was with him in one semester, but I will never forget the lessons I learned from them. In the case of Congressman Montejo, he was the one who emphasized that genuine friendship among people you meet will always go a long way. And in our class, while we were trying to memorize the Internal Revenue Code in the 60s, and he knew some of us are prepared to recite, he has a booby trap recitation. And I was the first one that he tried to trap. At the start of the semester, he said, I will require you to memorize your classmate's name on your left and your right. And if you cannot recite the name of your classmate on your left and your right, you get a grade of 5 even if you have studied taxation. And after a few meetings on the regular course of the subject income tax, he was really picking on me and called me and said, Bisquera, are you ready to recite? And I said, yes, sir. And he said, let me try another set of questions for you. I know you are very ready with the lesson on taxation today. So let me now exercise my discretion to ask you a question that I clarified at the very start. You need to know the name of your classmate on your left and your right. Are you ready now to do that recitation? And I had a very beautiful smile and I said, yes, sir. Except, sir, is it possible for me to ask you a favor to allow me to expand my coverage? So in addition to naming my classmate here, Albert Cham, on my left, and Benvenido Bulaon on my right, can I start with my classmate on the extreme right, moving towards the first row, second row, third row, and fourth row? And would you allow me to include the province where they come from? And you know, my classmates were all smiling because at that point I was candidate for the vice president of the UE student government, and they knew I can really remember names. And I remember Congressman Monteo said, oh, sabi niya, you are trying to show us something that is novel. Go ahead. So I started mentioning, for example, the name of my classmate, and I would say he comes from the province of Marulas, Bulacan. And I will mention the second name, and I say he is from Cebu City. And then I will mention another name, said he is from Bacolod City, Negros Occidental. And I was able to run the entire class, and I did not miss anyone. And I never forgot those names, even when we finished our subject under Monteo. And the beautiful thing about it is my classmates also did not forget my name. That is the secret of trying to remember names. When you try to remember a person, he returns the favor because perhaps you're the only person who bothered to remember his name. And so he will also try to return the favor. And so in this in YouTube upload, I have received some connect through email, through chat, through messenger, and obviously to direct comments here. Who would remind me we were classmates at UE in 1964 to 1968, and I do remember because I can also see the picture, although the person must have grown older by about 50 years, you know. And so therefore, that is the advantage. So to my mind, I am dedicating this slide to Congressman Montejo and to Attorney Macario Perez, if only to remember those sentimental things that I learned from them. So with this, ladies and gentlemen, I'd like to thank you very much, and I'd like to continue to welcome you to continue to log on to our sharing, and at the same time to subscribe to the note here. Marami pong salamat. Mahal na mahal ko po kayo, and I feel grateful that you're watching this particular thing. Salamat.